Hi, everybody, and welcome back to our video number 3 in Chapter 3. Uh, Beasley Enterprises has income. Here we're going to look at disclosure of intra-period tax allocation. So Beasley has income before income tax at $250,000, a loss of $100,000 from discontinued operations, and assuming a 30% income tax rate. So it's going to present the following information. Here we have income before income tax, here, income tax, income before continuing operation, but then we have loss on discontinued operations less applicable income tax. 70,000, it gives us net income. And notice the note here. During the year, they suffered a loss on discontinued operations of $70,000, net of applicable income tax reduction of $30,000. So I think that's pretty clear. All right, comprehensive income. Very important definition here. All changes in equity during a period except those resulting from investments by owners and distributions to owners. Okay, what does that include? All revenues and gains, expenses and losses reported in net income, and all gains and losses that bypass net income but affect stockholders' equity, and gains and losses that bypass income statement are often referred to or are referred to as other comprehensive income. Okay, so comprehensive income. Companies must display components of other comprehensive income in two ways. A single continuous statement, the one statement approach, which most companies do, or you can elect two separate but consecutive statements of net income and other comprehensive income, the two-statement approach. All right, here's what the one-statement approach looks like. Trader Bob's organic groceries. So you can see it's got sales revenue, cost of goods sold, gross profit, operating expenses, net income. And that income is going to, net income will eventually find its way to retained earnings during the closing process. Other comprehensive income includes unrealized holding gains, net of tax, and that's $30,000. And that is the sum of the net income plus the other comprehensive income. And this is the total comprehensive income. And that accumulates in the accumulated other comprehensive income. Key definition here. And those are permanent accounts are reported on the balance sheet. Okay. Again, it excludes investments by owners. That's where we sell and purchase common stock, or distributions to owners, payments of dividends, etc. Okay. Now, two-statement approach, we have our net income again here, but for a kind of a separate income statement, we start with this 110,000 and we back out our other comprehensive income, in this case, unrealized holding gain or loss after tax of $30,000. And the same comprehensive income, but it accumulates in the accumulated other comprehensive income, sometimes abbreviated AOCI. All right, gains and losses that bypass net income but affect stockholders' equity are referred to as A, comprehensive income, B, other comprehensive income, C, prior period income, and D, unusual gains and losses. Okay, And I think you would know, having just come from the prior slide, that the correct answer is going to be bravo, the other comprehensive income. So again, that comprehensive income includes net income plus other comprehensive income. Okay, let's take a look at using the two-statement approach, and this time for the Diego company. And here we have our cost of goods sold. We have other revenues and gains, unrealized gains on available for sale securities, gain on the disposal of the plastic division related to discontinued operations. Here we have the loss on the plastic division operations related to discontinued operations, net sales, other expenses and losses, and other operating expenses. They want you to prepare a multiple step income statement and a comprehensive income statement for Diego Company. The two-statement approach. The income tax rate is 30%, and the weighted average number of common shares outstanding is 10,000 shares. So if we do that, we get the following income statement. And the traditional format, we walk through what our revenues less our cost of goods sold, and back out our operating expenses here. That gets us income from operations. We have income from operations, and then we have other revenues and gains. We have other expenses and losses, negative 4,000, resulting in a $46,000 income before income tax. We pay tax on that, and we have income from continuing operations. Then our discontinued operations, we had a couple of them. One was the loss on the operations of discontinued operations, and that's net of tax of $18,000, and that results in a $42,000 loss. But we also had a gain net of tax of $15,000, so that gain of $35,000. I offset these two, and that's a $7,000 net loss. Subtracted here from income from operations gives me net income of $25,200. And now our income from continuing operations, we do the per share calculation by taking 32,200 divided by 10,000, and the 7,000 loss divided by 10,000. Subtract the 70 cents from the $3.22, I get $2.52. Now, if I look at the comprehensive income statement, here's my net income. We got that from here. Back out the unrealized holding gain available for sale of debt instrument net of tax. That gives me $10,500. So my comprehensive income is $35,700, recognizing that this $25,200 comes from here. Okay, comprehensive income. All right, let's take a look at explaining the reporting of the stockholders' equity. I think that last section was the most difficult in this chapter, but here we'll take a look at what affects retained earnings. Of course, you know by now, net income increases retained earnings, and it's possible we could have a change in accounting principle that might jack that up a little bit, or jack that down a little bit, as the case may be here. A prior period adjustment, very rare that you see that. That is an admission of a material mistake, and that's not going to please anybody. In any event, what would decrease it? A net loss. If we decide to pay any cash dividends, a change in accounting principle, or a prior period adjustment. Okay. So here is an example of the Stricker Incorporated. They prepared this income statement, And here's their statement of retained earnings. They start with beginning retained earnings. They add net income. They back out cash dividends. They back out stock dividends. And that gives us a $300,000 reduction. And finally, our ending retained earnings. And before issuing the report, Stricker discovers a $50,000, that's before issuing the report, they find a $50,000 inventory error net of tax that caused the 2024 inventory to be understated. That would cause the cost of goods sold to be higher, and therefore the net income to be lower in 2024. Would this discovery have any impact on the reporting of the statement of retained earnings for 2025? And the answer is yes. We're going to show that correction as a prior period adjustment here, net of tax. So we adjust the beginning retained earnings for that error. That gives us retained earnings in January that's gone up by $50,000. Then we add our net income and our cash, subtract out our dividends to get our balance. Okay, prior period adjustment. Again, very rare. Restrictions on retained earnings. If there's restrictions, that's not going to result in a journal entry. So in the interest of full disclosure, we're going to show those in the notes to the financial statements. And it's shown as unappropriated retained earnings. Appropriated. So, for example, the bank says you have to do this and you have to do that, but it doesn't result in any money moving in or out, then we would adjust that. So let's look at how that might be done. It's going to report changes in each stockholder's equity account and total stockholders' equity account for the period. So the following items would be disclosed in the statement. Here's contributions. We issue some shares, retained earnings, accumulated balances in other comprehensive income, and two, reconciliation of carrying amount of each component of stockholders' equity from the beginning to the end of the period. Okay, so here's an example. Off-brand has the following stockholders' equity account balances at the beginning in 2025. It's got common stock, it's got retained earnings, it's got accumulated other comprehensive income of 60 grand. No changes in common stock during the year, and net income is 110,000. Other comprehensive income due to an unrealized holding gain during the year is 40,000 net of tax. So how would you report that? You're going to have your statement of stockholders' equity here, which includes common stock. So this one's easy. We just have a column called common stock. And then we have retained earnings. Here's our normal retained earnings, beginning balance. We add net income. There wasn't any dividends. So our ending balance is 160,000. But we had accumulated other comprehensive income. We had a beginning balance of 60,000, right? And then we had an additional 40,000 of unrealized holding gain net of tax, total of 100,000. Okay. All right. And then finally, we have how we would present the off-brand incorporated. This looks like a good place for us to stop this video at this point in time. And when we return, we'll take a look at off-brand. Until then, bye for now.